Welcome to this webcast introducing IFRS 18, the forthcoming IFRS Accounting Standard for presentation and disclosure in financial statements. I'm Nick Barlow, and I'm joined by Juliane-Rebecca Upmeier.
Hello.
To start us off, Juliana, would you please share with us the helicopter view of how IFRS 18 will improve financial reporting and provide better information for better decisions?
IFRS 18 arises from the IASB's work on the Primary Financial Statements project and responds to investors' demand for better information about companies' financial performance. It will improve how information is communicated in financial statements and give investors a better basis for analyzing and comparing companies' performance. IFRS 18 will affect all stakeholders in the IFRS Accounting Standards ecosystem. So that our listeners can understand the likely impact of IFRS 18, Nick, can you share with us the key requirements that will be introduced by IFRS 18?
Sure. IFRS 18 will introduce three sets of new requirements. The first set of requirements creates structure in the statement of profit or loss by requiring companies to present two new defined subtotals. This will provide a consistent and comprehensive starting point for investors' analysis and help investors compare performance between companies, in particular using the operating profit subtotal, which will now be defined and therefore more comparable. The second set of requirements is that companies will be required to disclose information about some non-GAAP measures in a single note to the financial statements. We call these management-defined performance measures. This will help companies to complement information provided using the new structure for the statement of profit or loss with company-specific information about performance and provide investors with greater transparency about those measures. The third set of requirements enhances guidance on grouping of information, also known as aggregation and disaggregation in the financial statements. This will help ensure that investors receive material information, making financial statements more understandable and more useful.
Together, these three sets of requirements will provide better information for better decisions by increasing the comparability, transparency, and usefulness of information. The IASB is preparing for the launch of IFRS 18 in April 2024. The effective date for IFRS 18 will be 1 January 2027, giving companies sufficient time to prepare. There is an option for companies to apply earlier.
Juliana, so that our stakeholders can start preparing, should we take a closer look at each of the new requirements and the reasons the IASB is introducing them?
Sure. The first set of requirements relates to categories and subtotals in the statement of profit or loss. It responds to investors' concerns about the difficulty in comparing financial performance because companies' statement of profit or loss vary in content and structure. For example, operating profit is one of the most frequently used subtotals today, but until now has not been defined in IFRS accounting standards, resulting in companies applying different definitions to the same subtotal. IFRS 18 introduces, in the statement of profit or loss, three new defined categories to provide a consistent structure of the statement of profit or loss: operating, investing, and financing. And two new required subtotals to enable analysis: operating profit and profit before financing and income taxes. This slide contains an illustration of what a statement of profit or loss would look like for a company applying IFRS 18. The operating category is defined as the default category. The operating category includes anything that does not meet the requirements to be classified in the investing or financing categories. The subtotal operating profit or loss will give a complete picture of a company's operations. All companies will be required to present that subtotal, so it will provide a consistent and comprehensive starting point for investors' analysis. The investing category includes income and expenses from investments accounted for using the equity method, as well as income and expenses from cash and cash equivalents, and other investments that investors analyze separately to a company's operations. The financing category, together with the profit before financing and income taxes subtotal, will allow investors to analyze the performance of a company before the effect of its financing decisions. Operating profit is intended to include income and expenses used in key metrics of operating performance. For companies like banks and insurers that have what the requirements describe as specified main business activity, IFRS 18 includes requirements to classify income and expenses in the operating category that would otherwise be classified in the investing or financing categories. For example, a bank which provides financing as a main business activity would classify interest expenses in operating instead of in financing so that it can present net interest income in the operating category. Likewise, an insurer which invests as a main business activity would classify returns on investments held to service their insurance contract liabilities in operating instead of investing so that they can present net financial result in the operating category. Nick, can I hand back to you for the requirements for management-defined performance measures?
Many companies use non-GAAP or alternative performance measures in their communications with capital markets. Users find information about those measures useful, but also find they are not always transparent and can be hard to find, and sometimes change from period to period without explanation. To bring transparency and discipline in the use of these measures, IFRS 18 defines a subset of such measures referred to as management-defined performance measures, or MPMs, and requires their disclosures in the financial statements. As they will be disclosed in the financial statements, they will also be subject to audit. The scope of MPMs is a reflection of the focus of the project on the statement of profit or loss. Therefore, measures such as adjusted operating profit and adjusted profit are included within the scope, while measures such as free cash flows and return on equity are excluded. There are 3 key points to note about MPMs. First, to anchor these measures to subtotals defined by IFRS Accounting Standards, the IASB has limited their scope to subtotals of income and expenses. Secondly, to provide a link with external reporting, only measures that are included in public communications outside financial statements meet the definition of an MPM. And finally, to provide users with insight into how management views the company's financial performance, only those measures that reflect that view are in the scope. IFRS 18 will increase the transparency around these measures by requiring a number of disclosures to be included in a single note. A key aspect of the disclosures is that each MPM will be required to be reconciled to the most directly comparable subtotal or total defined in IFRS Accounting Standards, for example, operating profit, which will increase investors' understanding of how MPMs compare with measures defined by IFRS Accounting Standards. Companies will also be required to disclose explanations of why each MPM is reported and how it is calculated. And to further improve the discipline in the disclosure of MPMs, any changes reported will need to be explained. Disclosures about MPMs are requirements that both preparers and investors tell us they are looking forward to. Preparers, because they can provide their view of performance within the financial statements, and investors, because they expect greater transparency of management's view. Juliana, can I hand it back to you for the 3rd set of key requirements?
Sure. The last set of requirements are related to grouping of information in financial statements, otherwise known as aggregation and disaggregation. These requirements respond to investors' concerns that some companies do not provide enough detailed information, and that sometimes important information can be obscured. Therefore, IFRS 18 will introduce enhanced requirements for grouping information, including requirements for presenting and disclosing operating expenses. IFRS 18 will also provide guidance for a company to determine whether information should be presented in the primary financial statements or disclosed in the notes. A company will present information in the primary financial statements to provide useful structured summaries of the company's income, expenses, assets, liabilities, equity, and cash flows, and disclose other material information in the notes to supplement the primary financial statements. Finally, IFRS 18 will also include requirements to help companies determine meaningful labels and disclose information about items labeled as other. So Nick, these are the 3 key sets of requirements that will be introduced by IFRS 18. Would you be able to explain how IFRS 18 will be structured?
Sure. IFRS 18 is a new accounting standard that will replace IAS 1. As already mentioned, it includes new requirements on presentation and disclosure, as well as some requirements brought forward from the existing IAS 1 with limited wording changes. IFRS 18 will not change the way companies recognize and measure items in the financial statements. However, most companies we expect changes in the presentation of the statement of profit or loss and disclosure in the notes. In addition, the IASB will be issuing limited amendments to other IFRS accounting standards, including limited changes to the statement of cash flows. This package of requirements will be released in April 2024. Juliana, what tools will be available for stakeholders to start preparing for IFRS 18?
Once IFRS 18 is released, the standard and accompanying material will be published on our website. We will also publish a series of webcasts that dive deeper into the key new requirements for subtotals and categories, management-defined performance measures, and aggregation and disaggregation. So please keep an eye out for those. Also, please follow us on our social media channels to keep up to date with developments on IFRS 18 and other IFRS accounting standards. That concludes our webcast. Thank you for watching.